All right, last week, federal regulators took over Silicon Valley Bank, or SVB, after it went under in the second largest bank failure in U.S. history.
So will the effects of the California bank's failure be felt here in the Gem State?
Our Jude Binkley talked to an economics professor at Northwest Nazarene University about what happened and how it could affect the economy. Jude, what'd you learn?
Well, Morgan, most importantly, the professor says Idahoans don't need to worry about their banks failing. He explained that SVE is a bank that was heavily leveraged in government bonds, government-backed mortgage securities, and longer-term lending, a major factor that led to its failure.
The CEO and CFO on the earnings call were saying that they don't anticipate growth continuing.
Dr. Peter Crabb is a professor of finance and economics at Northwest Nazarene University. He says the Silicon Valley Bank was heavily leveraged in government securities at a time when the Fed was tightening monetary policy and raising interest rates.
And so the interest rates went up, but not on the bonds that they had already made. So the value of those bonds went down. And so the deposits were still there, but the assets of this bank, the loans they made, were losing value. And as they started losing value, and particularly last week, some large depositors of this bank said, we've had enough and we're taking our money.
The events led to a liquidity crisis.
They were very exposed to rising interest rates.
Basically, the bank ran out of available cash, so the federal government took over. But Dr. Crabb says Idahoans should not worry about banks here because unlike SVB's heavy leverage in government bonds,
other banks have been generally prudent in not lending to just one area, spreading their assets among different securities. And when interest rates are going up, they take actions to prevent that risk of hurting them.
the federal government will be covering all deposits at SVB, including ones that were not insured, above FDIC insurance levels. The FDIC usually covers up to $250,000 of an account.
The federal government decided essentially to bail out everybody.
Dr. Crabb says a bailout like that sets a dangerous precedent if this were to happen to other banks.
They have essentially said you can deposit your money anywhere and don't worry about it. This is what economists call moral hazard problem. So the moral hazard problem is the risk that you'll take undue risk with other people's money because you're not going to have to pay the consequences of that. And so the actions of the federal government this week have just raised the moral hazard problem. They bailed out everybody. So sentiment is uncertain. Well, will they do that for every bank? Are all banks now fully guaranteed no matter what they do? So potentially a dangerous precedent has been set this week.
Now, the Department of Justice announced this week that they'll be investigating the history of SVB. They'll be looking at transaction histories and relationships to figure out how SVB got into the situation. Now, the money used to cover deposits at Silicon Valley Bank is coming from the FDIC's Deposit Insurance Fund. And that's a program funded by fees paid by banks and interest earned on government bonds.
And Jude, we know a lot of startups that had money in SVB were already struggling with tech layoffs and all the other issues plaguing the tech industry right now. So not a good situation all the way around, Jude. Thank you.